Good morning, everyone, and thank you so much for joining us today on our webinar on originating more jumbo loans. Now, as questions come up, please go ahead and type them in to the little questions tool. We're going to have an extensive Q&A at the end of the session, and we'll get to all your questions. With that, I want to turn it over to today's speaker, Mark Lutzi. Take it away, Mark.
Good morning, everybody. My name is Mark Lutzi, and good afternoon to those of you on the East Coast. With me today is also a man with the smile of a prince and a voice of an angel, Mr. Tim Turley. Good morning, Tim.
Thanks, Mark.
You got it, sir. So I appreciate Tim on board with me here. He's going to be helpful to our Q&A at the end. So let's kick things off, and I want to talk a little bit about today's agenda. So I'm going to go over just a couple of things, who we are and why you'd actually want to partner with us in the future if you've not already done so. We're going to talk about today's exciting home buyer market, and boy, is it on fire. We're going to get into the jumbo landscape and how that's changed. We're going to talk a little bit about rescuing some of these jumbo fallout deals that are happening in your pipelines today. There are opportunities out there for self-employed business owners and investment properties in the jumbo arena that we want to open up your eyes to. We want to talk about lowering jumbo rates, even though that they're incredibly low already. We're going to teach you how to even offer lower rates than our posted rate sheet and make you more competitive to your competition. We're going to talk about how easy the process is with our pre-qualification process to close a non-QM jumbo. There are other opportunities we'll get into, marketing and resources, and then we'll end it with a Q&A. Sound good? So a little bit about us. We've been in this business now for 6 years. We were founded in 2015. We're headquartered in San Diego, but we do have operational centers in both Rhode Island and in Georgia. That's where Mr. Turley is. We have a highly experienced non-QM management team. Some of you may have heard of or know Joe Lydon and Stu Marvin. They're our co-founders, and they've been in the business for, 30 to 40 years, and we really appreciate their leadership. Lending in 42 states and continuing to grow, and yes, we do non-owners in New York presently, so call your account executive today if that is something of your interest. So let's talk a little bit about today's exciting home buyer market. You just can't turn on the TV or read an article without seeing all of the explosive news, things like, home sales that are expected to rise 9% this year. New builds are to rise to 21%. That's just unheard of. Market appreciation of 8% nationally and much more in certain areas, and I'll talk about that as well. So the normal home buying experience is that you're up against multiple offers made on not just hot properties, but pretty much any property. My neighbor next door put his house on the market officially on Saturday, and they came in with 21 offers in one day. So yeah, I would call that competitive. So borrowers with solid pre-approvals have a better chance on accepted offers, and of course, non-contingent borrowers have the most competitive offers to make, but pre-approved borrowers are basically the second best. The last is a stat that we picked up when creating this PowerPoint, and I found it very amazing. 312 US cities now have an average home value of $1 million, and most of them are clustered in 9 East and West Coast metro areas. So let's talk a little bit about that. The growth of the jumbo market is just increasing month over month and year over year. This slide actually shows that way back in 2015, a whole 6 years ago, only 208 US cities had an average home value of $1 million plus. Well, just since then, it's grown to 312 US cities that are now over $1 million. That's just incredible. And then with the growth that you're seeing in the 2021 market, I wouldn't be surprised if it was going to be closer to 350 by year end. I decided to put up a slide just where I live. This is my hometown, San Clemente, California. It's got 88,000 people. We live right here on the seaside. You can see by this information, this is a seller's market, and that our average home sale is now at 1.3 million, and that's trending up 20% from last year. The median sale is 1.2 million. So we made the list of being a city over a million average in December of 2018, if you see that little graph down below. And if you list your house in San Clemente today, you're likely going to get offers and accepted offers over your listing price. And you can see that in the sale to list price ratio is 100.24%. So if you're in the market to sell, boy, you're really looking good. So let's talk a little bit about things that are happening in the jumbo market that aren't good. And let's talk about the fallout. The pressure on the underwriting guidelines is extreme. To qualify for these large loans, it's income, equity, it's assets, it's reserves, it's all of these things, bound together in one nice underwritten file. And I will tell you, anything falls out of place and you're now a fallout. Well, we want to give you a heads up that we're here to help with these situations. We're funding non-owner loans in 3 days and TRID-compliant owner-occupied loans in 10. So we accept transferred appraisals. And if you have anything that's on your desk right now that is on fire that needs to be closed, although it fell out, we accept AMC appraisals, transfer to us. We have unsurpassed funding turn times, common sense exceptions, and on our bank statement loans, we don't even require P&L statements. So we're very competitive, we're very fast, and we have the ability to take your jumbo loans from a full package status to a funded status in a very short period of time. So contact your account executive today if that's happening to you. So a LendSure non-QM jumbo, why is that different than a prime jumbo or just a regular jumbo from a bank offering? The non-QM jumbo gives you multiple ways for a large loan to qualify for. First of all, our loan amounts go all the way up to $3 million. We accept higher debt ratios on full doc or bank statement loans all the way to 50%. We allow non-warrantable condos, and that's a big thing in today's market, knowing that Fannie has released all of its recent news regarding their appetite for non-warrantable. We do bank statement loans for jumbo loans, and that's a big deal. People that are looking to buy a $3 million, $4 million home, but their tax returns aren't allowing them to qualify, and they're self-employed. We have the ability to do bank statement loans for them. We also have an investor cash flow or a DSCR loan, debt service coverage ratio, and we can do those up to $1 million, and we can even make exceptions to those loan sizes as well. We can deliver cash out to $1 million on most of our loan programs. We allow some mortgage delinquency, that is to be considered case by case. And we do allow multiple sources of income combined together for the loan to debt ratio. So with that said, let's go back to the jumbo bank statement loan. There are self-employed home buyers that have trouble documenting their income. They may be taking full advantage of the benefit of their write-offs on their tax returns. But when it's time to qualify for a home loan, they may have trouble. So people with bank statements and self-employed do have another option with buying a jumbo home or a jumbo loan and qualifying with their bank statements instead of a full doc tax return. So the LendSure Jumbo Bank Statement Program allows loans to $3 million. Now pay attention to these FICOs and LTVs. At 70 LTV, we can go up to $2 to $3 million with a FICO score of 680. That's incredibly low for these types of loans. LTVs up to 80 for $1.5 to $2 million with a minimum FICO score of 680. And then ultimately 90 LTV with a $1.5 million cap, with a minimum FICO of 680 as well. We upfront evaluation of income. That is our pre-approval process that we go through. We actually vet out the income and give you the income that we're going to utilize for the loan, so that when you're able to talk to your borrower and go through the initial disclosure process, selling the terms, the interest rate, that it ultimately doesn't have to be changed or redisclosed downstream. These are the loan terms that we're going to actually close at. We have a 12 and 24-month option. The 12 is slightly more expensive than the 24 in regards to bank statements. And then we have a P&L requirement that we have waived on 12 and 24. So we do not have to have a P&L on either of those programs. The borrower does not have to be 100% owner of the business. We allow them to have partners, business partners. And then we can either do personal or business bank accounts, but we prefer business. It seems like we're able to maximize a borrower's business income more than on the personal income. And then lastly, our variable expense factor is one of the things that truly sets us apart from our own competition as a lender. And this is where we investigate the borrower's business and determine the applicable expense factor so that it actually makes sense to the business. I'll give you an example. Let's go to this loan scenario. We have a borrower that wants to buy a $1.5 million home. They want to retain their current home and rent it out. The person's a psychiatrist and has no employees, has minimal rent for $800 a month, very small overhead to run the business. The loan officer that had contacted us was currently working with a different lender. That lender was using a 50% expense ratio, and because they could not get the loan to debt to income ratio under 60. Well, they gave us the opportunity to pre-approve the loan. We used the 10% expense ratio because of the minimal expense to run the business. And we also use market rent for the departing property. And because of our variable expense ratio, we actually had a 37 DTI. We gave them 90% of the borrower's income to qualify. So you can see this went from a turn down to an approval in just a bat of an eye. It was just simply calling the right lender. So our variable expense ratio stands out as a deal maker across the jumbo arena in our competition. Let's talk a little bit about jumbo investment property. So in actual markets across the country, you're seeing loan needs for the investors of the world here that are trying to buy some of these larger properties. According to Statista.com, there are over 43 million investment properties in the United States. Many use hard money loans because they're quick and they usually have short-term balloons and with upfront points and high rates. It's a quick source of capital for an investor. Property investors typically have multiple properties and continually add to their portfolios, creating a stream of purchase and refi opportunities for years to come. That's a good borrower to have in your Rolodex because they will continue to be in need of your financing options. So multifamily investments is another sector of the jumbo market that's rebounding. If you can see on this slide, for the last 12 years, the market has increased from 2009 all the way to 2019. But COVID gave it a gut punch. It's down considerably. But you can see now that in 2021, with the markets back to where they are and the availability of jumbo products, it's rebounded. I'm excited and hopeful that it'll rebound in continuing into 2022. So multifamily investment, 2-4 units is something that we actually have in our jumbo arena at LendSure. So jumbo investment property loan options. So there's many different ways that we can get your borrower to qualify. One thing I haven't talked about yet is asset depletion. We actually have two asset oriented doc types. One of them is going to be an asset qualifier, and we divide your assets by 60. And then the other one is asset depletion, and we divide that by 120. Each one of them has a certain set of guidelines depending on the borrower. But we do have the ability to use these asset programs in combination of somebody's self-employed business bank statements, as well as adding maybe Social Security. There's many different things in forms of income that we can get to get your borrower to actually qualify. So we also do bank statements, like I mentioned. And then lastly, the cash flow DSCR program is very popular right now. So this is the ability to cash flow, qualify based on the rents divided into your PITI. Another factor that we have that we utilize quite often for our investors is the ability to utilize an interest-only 40-year fixed loan. So this loan is actually interest-only for 10 years. It converts then to a full 30-year fixed loan, fully amortized at the same interest rate. So I'll give you an example of how effective this is specifically for investors. $1 million purchase, 20% down, $800,000 loan, and it's projected that the market rents will be $5,000. So we put this on the DSCR loan. We priced it out at rate sheet at 4.875. The monthly principal and interest on that is $4,234. You add in the proposed taxes and insurance is $1,400. A total monthly payment $5,634. Well, you cross that with the $5,000 of rent, and your DSCR score is at 88.75. Well, that's $634 monthly in negative cash flow to your investor, as well as a DSCR score under 1 would require an additional pricing bump of 0.25. So now your interest rate would actually go to 5 1/8. But by converting the loan over to our IO 40-year, look at the significance and what it does. Your 4.875 par rate is an add for a quarter for IO. You're now at 5 1/8. For the first 10 years of the loan, it's interest only, but look at this payment, $3,417. Added in taxes proposed and insurance for $1,400, you're at $4,817. Now that's a DSCR score of 1.15, and the investor receives $183 of positive cash flow every month. That's $817 more cash flow than the 30-year option. And it's just simply supplying the math and the numbers to your borrower. Most investors are going to choose the positive cash flow option. The Jumbo DSCR is an ease of use product. There's no income required to qualify. Your DSCR ratio is your income. You only need to complete the schedule of real estate owned. You do not need mortgage ratings on other properties. And when you're talking to your processor and they're tracking down a real estate portfolio of 25 loans and mortgage ratings on those, they're pulling their hair out. It's not easy for them. We try to make this program as easy as possible. You do not need to verify taxes and insurance on other properties, another time suck. Close multiple loans for the same investor at the same time. I will give you an understanding that I'm doing a 20-pack this month for an investor. The investor has many more properties than that, owns all 20 of these loans free and clear, homes free and clear, and wants to do 70% cash out on all of them. We're in the process of doing all of that, and we'll be closing 20 loans at one period of time. Is that an exception? Yes, but we've done that. Fast closings and minimal conditions is the goal with this program. So calculating a DSCR score is pretty simple, but I just want to make sure that you know how to do that. You take your gross rents, or you get your market rents off the 1007, and you divide that by the PITI, or if there is an association, you add that to the payment as well. If you're under 1, that means that if you're over 1, there is sufficient cash flow to cover the debt service ratio. But if you're under, there is not. So our guidelines for purchases is that you can go down to 0.75, but there's a price add of a quarter until you get to 100. If you are over 100, you're fine for a refinance. And again, you can use the IO payment to qualify for that ratio. So the LendSure Expanded Investor DSCR, we allow up to 80 LTVs for purchases, 75 LTV for rate and term, cash out. We can do loan amounts up to $1 million, cash out as high as $500,000. No limit on the number of properties owned. You can finance up to 10 properties for one investor, but as I mentioned, I'm currently doing 20 for one investor. Non-warrantable condos allowed. Qualifying IO payment, excellent for qualification and cash flow purposes. So here's a loan scenario that's gonna kind of walk you through that. we were contacted from a loan officer. They have a borrower that owns a free and clear property in San Francisco. It's a 2-unit. The borrower wants $1 million immediately to make an offer on 2 other non-owners in the Bay Area. He wants to put $500,000 down on both. So we immediately decided that the best way to go was the DSCR loan. The borrower owns 3 different businesses and has a schedule of real estate of 17 non-owner properties. If we were to go traditional full doc on this, you can imagine the complications of getting all of the business tax returns, all of the not just the schedule of real estate, but all of the taxes and insurance, all of the mortgage ratings, everything that goes along with a full doc loan is going to be in combination. And the borrower was just not excited about supplying all of that documentation. In addition, he was immediately in the need of $1 million cash to be able to put an offer in for these 2 homes. So the solution, we did the DSCR loan. We asked for no income to be documented. We allowed the borrower to receive $1 million in cash out. And yes, that is an exception. And we were able to close the loan in 8 days. And subsequently, we were able to do the 2 purchases with $500,000 down. So it was a total of 3 loans for the loan officer. Worked out great. Lower non-QM jumbo rates. So let's get into this. How can we actually offer lower rates in our rate sheet? Well, it's kind of a sophisticated way of doing it. LendSure offers borrowers the additional flexibility to buy down their rate and finance the points. So they're buying down the rate, but we're going to actually finance the points on top of the loan. The lender and the broker points can be financed into the loan up to 2% on an 85 LTV loan or any LTV lower than that. We just do not offer this product on the 90% loans. So I want to make sure you guys understand that your broker points, meaning your origination points, if you're offering 2 or 1.5 or 1 or whatever it is that you're going to have as your commission, we're able to finance that on all loans at 85 LTVs and less. Finance points do not raise the LTV pricing bucket. So if you're in an 85 LTV bucket, you remain there. You do not go to the 90 bucket. Up to 87 LTV when financing points at the 85 pricing tier. So you actually will be closing at an 87 LTV, but you will be in the 85 pricing tier. Borrowers do not have to bring the additional cash to close. We finance it. And the lower rate significantly lowers the monthly payment. Now let me explain. Our current conversion for buy downs is 2 to 1. So what does that mean? That means that if you were to take 2 LendSure discount points, you would be buying down the interest rate of 100 basis points. So you would go from 5% to 4%. So here's it put on display for you so that you guys can see it. It's $1.5 million purchase price. It's a loan amount of 1.275. The down payment's $225,000, and your LTV that they've requested is 85. Well, when you price that out on our rate sheet, it's 4.75. Your rate buy down is $25,500. The new rate is 3.75. So most lenders that I'm competing with that you may be shopping to, they may have the ability to buy down the interest rate as well. So we all could be at the 3.75. That's a possibility. But we're at an 86.7 loan to value with a loan amount now of $1,300,500. And the borrower didn't bring any of the $25,000 in closing costs to the table in cash. They were able to finance it and receive a 3.75% interest rate. It makes you wildly competitive. I hear quite often that the broker down the street or the banker down the street have me beat by 100 basis points. I hear that, and that's usually us working with that loan officer. So join the competition. Be fiercely aggressive on your interest rates. It makes you wildly competitive. So here's a loan scenario that kind of walks you through this. We had a purchase request at $2.4 million. It was an SFR. The borrower had 30% down payment. The loan amount was for $1,680,000. FICO score, the credit had no issues, 802 FICO. The borrower had over $1 million in assets. He was a doctor, he was an orthopedic surgeon. And for the past 4 years, he made basically $750,000 W-2'd at the practice that he worked at. Well, during that period of time, they made him partner with the firm. And because of that, that changes the way that you now become self-employed. You're an owner of the practice. So they converted him to 1099. And all he had was a letter that basically stated what the projected income was going to be for his partnership. So he applied to a normal traditional bank. They turned him down because he had not required the 2 years of self-employment. So went to a mortgage banker, and the mortgage banker had to turn him down. The third loan officer that this borrower worked with was one of our customers, and they came to LendSure. So here's what we did. We accepted this borrower by tracking down the previous 4 years, showing the trends of the income as a W-2 borrower. And then we accepted the letter of the 1099 partnership, and we showed the last 6 months of deposits of that income being shown into the bank statement to show the full documentation of the income. Not only did we get over that hurdle, but the second issue with this borrower was he was incredibly price sensitive. Interest rate shock was a huge issue. So when you went from a regular jumbo loan into a non-QM jumbo loan, there is that price difference. And so the borrower was asking, what is the absolute lowest interest rate I can close at? So the loan officer had asked us, and we said, well, we're able to buy this down to our floor rate. And at that time, it was 3.25% on a 30-year fixed. It took 1.5 points from LMC, and we bought it down. But guess what? We stacked those closing costs on top of the $1.68 million loan to a $1,705,200 loan. And the borrower was absolutely ecstatic. The interest rate change from the prime jumbo that he was turned down from to the one he closed with was barely the same. It was within an eighth. Yes, there was some LMC discount points, but not only were they stacked, but the borrower's been in the home now for 3 months, and the appreciation that he's gained on the home has already paid for that 1.5 points. Remember, in some markets like San Clemente, we're at 20% appreciation, but the average in the country is at 8%. So if you take advantage of this, the future equity on any purchase is going to take care of these buy down points within months. Today's opportunities with LendSure, well, we have a lot of things going on. I'm here to talk to you about jumbo loans, but we do have a bridge loan program that helps people not become or helps people become non-contingent as far as buyers. We do cash out loans to $1 million. We allow non-mortgable condos. We do condotels, which is something that is really starting to heat up in these vacation areas. Condotels are becoming popular, and Fannie Mae has no interest in them anymore. 2 to 4 unit properties, we spoke a little bit about that. We have the ability to do those even on jumbos. Second homes, that's another popular market with the market rebounding. In a sense, Americans are looking to vacation, and second homes is becoming another desirable financing option, and we do those even in the jumbo market. Asset depletion can be used as sole source of supplemental or the source of income. So we have the ability to combine the income, or we could just simply use asset qualifier for a very simple ability to solve ATR for that borrower. Interest-only loans available. I got into that quite deeply. Foreign national loans are very popular with us. We're highly competitive in that. And then we do construction takeout loans as well. Lease options and land contracts can be treated as refinances. So these are all opportunities that you may want to consider turning your way to LendSure and seeing what we can do for you. So why partner with us? Well, we operate with flexibility based on compensating factors and common sense human decisions. So we do not have an AU engine behind us telling us what we need and if the loan is approved or not. We have human beings that are highly trained and been doing this type of lending for many years. We make common sense exceptions, and I stated that throughout some of these loan scenarios. I really want you to provide the understanding that, you guys see underwriting guidelines and grids and where loans fall in and out of. Not everything fits those grids perfectly, but compensating factors allow us to make exceptions and approve loans. We have experienced AEs that will assist in structuring files and providing the best pricing options. I would tell you that we have a high in-class workforce. They're highly trained. They know how to structure loans for you. They know how to put the best possible pricing options in front of you. We do this on a day in, day basis. This is something that it allows us to use our brain and think through loans as opposed to just an AU or DU just submitting loans in and spitting denials or approvals out. Our pre-qualification process allows you to feel very comfortable with everything else. So once you're through the pre-qualification process and you have a pre-qual signed by us, that's the pricing that we intend to close at. That's a loan that we intend to close. We have vetted through that loan, and you should feel very comfortable selling that to your borrower. We do have regional specific operations teams because every region in the country has certain types of lending that come with the landscape. So for example, high rises in Florida, you deal with jumbo markets out here in California, etc. So bottom line, we encourage the communication between brokers and our pre-qual underwriters to help build files up front so that everybody gets to have somewhat of a Fannie Mae experience once you actually submit the loan to a regular line underwriter. It should come out as approved. You should have anywhere between 8 to 10 conditions. We clear those and we're off to CD and closing. So with that said, I'm going to turn this over to Rose, and she's going to talk a little bit about the marketing capabilities.
Thank you, Mark. So yes, we do have private label resources that you can access. There's the URL which you can access, and it includes customizable flyers, it can banners that you can use on social media, postcards, and even Outlook email templates. They're very easy to customize. You can put your logo on them, your contact info, your disclaimers. And if you have any trouble at all customizing these, just reach out to your LendSure account executive. That's what they're there for. They will help you customize these and provide you the resources that you need so that you can start selling more jumbo loans within the next 30 days.
Thank you, Rose. Lastly, I think we want to close with this, and this is basically a reach out to each one of you that's on this webinar today. If you're currently working with LendSure and you have an account executive, I challenge you to take that relationship to the next level. Test them on their ability, and I think you'll be pleasantly surprised on what they can deliver for you. In addition, let them work with you to help you grow your business. With PowerPoints, flyers, emails, templates, social media templates, we have a very robust marketing department that's here to help you to get further into this non-QM space. Non-QM is the fastest growing space in the mortgage industry, and we invite all of you to be a part of that success. Lastly, if you're not currently working with an account executive at LendSure, I encourage you to reach out to us so we can align you with one in your marketplace. We're excited that you were on the call today, and we want to help you close as many deals as you possibly can and be a great support structure for your business. And with that, I'll turn this over to our Q&A and invite Mr. Tim Turley to join us as well.
All right, thank you so much. And everyone, please go ahead and submit your questions in the little questions tab. I'm seeing a lot of questions asking if there's going to be if this is being recorded, if you guys can get a copy of the slides, etc. So yes, this is being recorded, and in about an hour after the webinar ends, you'll be receiving a thank you email from me, Rose Waldy, and it will have a link to the webinar recording and a copy of the slide deck, so you don't have to worry about missing any information. I'm not seeing a ton of questions. I have a nice comment from Rich. It says, I only did one loan with LendSure and the representative, Jim, and the backroom team was incredible. Thank goodness for them. I look forward to doing more loans in 2021. Great experience. Thank you so much, Rick. What a great content. Go ahead and submit any other questions that you guys may have. Mark, Tim, we're going to just give everybody a moment to see if any other questions come in.
Sure. I was going to make one quick comment that Mark touched on the exceptions, and I was just reviewing some numbers for so far year to date. Over 40% of our loans that we've closed have had exceptions to our guidelines. So, don't read into a guideline and think there's not a loan there. We're looking to make loans, and we make a lot of exceptions. So
we've got a question from Ryan. He wants to know borrower paid or lender paid comp. I guess that relates to the stacking.
We can do both. We do borrower paid and we do lender paid. Obviously, if it's borrower paid, then it's coming out of their funds. We do lender paid comp as well, depending on how you sign up with us. And we can stack up to 2% in LTV on any loan up to 85% LTV.
Awesome. Stephen wants to know if we're financing condotels.
Yes, we are doing condotels. Actually, they're becoming quite common. I've got where I see them almost daily, and we basically treat them as a non-warrantable condo.
Great. Jonathan wants to know the 10-day close on a fallout deal. Is that only for jumbos, or would a regular loan also fit in that turn time?
As long as if it's a TRID loan that requires us to follow TRID, it can be any of our regular loans as well as jumbos.
Okay. Da, da, da. Okay, I have not let's see, I have not worked with LendSure before. My clients are very rate sensitive, and I lose loans to the big banks like Chase, Wells, as they are very competitive on jumbo. How's your pricing compared to the big banks?
If they're going with a traditional conforming rate, I would say that, as Mark said earlier, we can get down to probably, within an eighth in some cases of their rates. I don't know that we would ever get all the way down there, but these borrowers typically aren't going to be able to qualify for that financing. So the example he gave earlier on the slideshow was actually an excellent one, where we were able to buy the rate down to 3.25 on that jumbo loan.
Okay. And how are pending divorces handled? For example, getting divorced wants to purchase a home.
We look at them on a case-by-case basis. I looked at one last month, and they did have a separation agreement, and we were able to move forward with that without the divorce being finalized.
Okay, and I think that is all for our questions. I want to thank everyone for joining us today. Mark, do you have any closing comments?
Nope, that's it. I appreciate everybody being on the webinar, and have a great day.
Tim, do you have any closing comments?
No, just send us some business. Thanks everybody for joining us, and look forward to talking to everyone soon.
All right. Thank you, everyone. Have a great day.
Take care.